In February 2015, the world's oldest central bank crossed a forbidden line. The Swedish Riksbank lowered its main repo rate to minus 0.1%. For the first time, in a modern, advanced economy, money itself turned upside down. Savers were no longer rewarded for holding their wealth. They were punished. The decision stunned the world. Economists had spoken of negative interest rates only in theory. Yet here it was, in reality. By 2016, the rate was cut even further, down to minus 0.5%, where it stayed for nearly 3 years. The experiment lasted until December 2019. But this was more than monetary tinkering. It was a radical inversion of the most ancient principle of finance. For thousands of years, from Mesopotamian silver loans to medieval Venetian bankers, interest had always flowed one way. The debtor pays, the creditor receives. Sweden reversed that law of civilization itself. Why? Because of a number. Just one number. Inflation. By 2014, Swedish inflation had collapsed to 0.5%, far below the Riksbank's official 2% target. Despite economic growth running near 3% and record high employment of nearly 80% of working-age Swedes, prices were not rising fast enough. The guardians of money believed this was a threat. They feared deflation, stagnation, and the shadow of the 1,930 seconds. So they pulled the lever no one thought could be pulled: negative rates. But here is the hidden truth. While the public was told this was about saving the economy, it was in fact about saving a system. A system built on endless debt, inflated assets, and the illusion of control. Look at the data. When rates fell below zero, Swedish housing prices surged by nearly 50% between 2012 and 2016. Household debt climbed to record highs, surpassing 180% of disposable income. Meanwhile, the krona collapsed. From 8.5 to nearly 11 against the euro, a 20% devaluation in just a few years, ordinary families felt poorer as imported goods rose in price. The official story said inflation had been restored. By 2018, the consumer price index briefly touched 2%. But if you dig deeper, you see something else. Swedish inflation tracked almost exactly the same path as the Eurozone. The correlation with European unemployment was minus 0.8. In other words, the rise in prices had little to do with Sweden's negative rates. It came from abroad, from the recovery in the euro area. The negative interest rate experiment was less about lifting Sweden and more about keeping the illusion of monetary power alive. This is the secret history of money. What is presented as protection for the people is often protection for the system. A system where debt must grow, where banks must lend, where prices must rise, or else the machine breaks down. The Riksbank governor, Stefan Ingves, himself admitted it. He called it an experiment. Not a policy, an experiment. And every experiment has subjects. In this case, it was the Swedish people. But the true mystery is this. How did the world's oldest central bank become the first to enter financial territory no one had ever dared? To understand how Sweden crossed into the unknown in 2015, we must rewind. The story begins not in Stockholm, but in the ashes of the global financial crisis of 2008. When Wall Street burned, Sweden trembled. Exports collapsed, banks shook, and GDP shrank. But then something strange happened. Unlike the United States, unlike Southern Europe, Sweden bounced back with astonishing speed. By 2010, Swedish GDP had already surpassed its pre-crisis level. Inflation even rose above the 2% target. It seemed like a miracle. The Riksbank responded by raising its policy rate. From near zero in 2009, it climbed to 2% in 2011, a signal of strength. Sweden, the oldest central bank in the world, declared itself safe from the storm. But the storm was not over. The Eurozone crisis soon spread across Europe. Greece, Portugal, Spain, the common currency faltered. And with it, Sweden's trade-dependent economy began to feel the chill. By 2014, Swedish inflation had fallen to just 0.5%. That number terrified the central bankers in Stockholm. Not because the economy was weak. On the contrary, growth was strong, close to 3%. Employment was at record highs. Nearly 80% of working-age Swedes had jobs, more than even before the 2008 boom. The economy was booming, but prices refused to rise. This was a riddle, a paradox, and for the guardians of monetary orthodoxy, it was intolerable. Why? Because modern central banking rests on one doctrine, the inflation target. In Sweden's case, 2%, not higher, not lower. A precise number, chosen by law and ritualized in policy. If inflation drifts too far beneath it, faith in the system itself is threatened. In December 2013, the Riksbank cut its rate to 0.75%. In 2014, to 0%. Yet inflation still refused to obey. The numbers did not move. By early 2015, the patience of the Riksbank snapped. At the same time, pressures mounted from outside. The European Central Bank under Mario Draghi had unleashed unprecedented measures. The Bank of Japan was drowning its markets in liquidity. The Swiss National Bank and the Danes had also resorted to negative rates to defend their currencies. Sweden could not stand apart. The krona was too exposed. The export machine, too dependent on Europe. To keep up, Sweden would have to match the others. And so, the stage was set. In February 2015, the Riksbank slashed its repo rate below zero for the first time, minus 0.1%. Bond purchases followed, nearly 300 billion kronor in just 4 years, equal to 6% of GDP. The guardians of Swedish money had chosen the path of experiment. But the real turning point was not that they lowered rates. It was that they changed the very meaning of money itself. What had been a store of value became a wasting asset. What had been safe became costly. That shift carried consequences far greater than inflation. It touched housing, debt, currency, and inequality, forces that would ripple through the lives of millions. The decision was made in a quiet boardroom in Stockholm, but its echo would shake every Swedish household. And yet, even this was only the beginning, because the real drama came not from what the Riksbank intended, but from what they unleashed. The question is, when money turns upside down, who gains and who loses? When Sweden crossed the threshold in 2015, the headlines celebrated. Negative rates restore inflation. The Riksbank defies gravity. It sounded like victory. For a moment, the numbers agreed. Inflation, which had languished at 0.5% in 2014, began to creep upward. By mid-2018, it touched 2%, the holy target. On paper, the experiment had worked, but look closer, and you find the cracks. Start with the currency. In 2012, €1 bought 8.5 Swedish krona. By 2019, after years of negative rates, it bought almost 11. A 20% collapse in purchasing power. Swedish households paid more for imports, from German cars to Italian wine. Their wages bought less. The policy made the nation poorer in silence. Then, the housing market. Between 2012 and 2016, property prices surged nearly 50% relative to disposable income. Apartments in Stockholm doubled in value within a decade. Young families were locked out. Debt soared. By 2018, household debt reached 180% of disposable income, one of the highest in the developed world. The Financial Supervisory Authority stepped in. Amortization rules, debt ceilings, stricter lending standards. But these bandages did little to slow the momentum. Inequality deepened. Those who already owned property watched their wealth balloon. Those without were left behind. This was not stability. It was imbalance. And still, the Riksbank defended its course. Governor Stefan Ingves reminded the public that inflation was back near 2%. Yet the truth is stark. Swedish inflation rose not because of Stockholm's boldness, but because of Europe's recovery. The correlation between Swedish inflation and Eurozone unemployment was minus 0.8, almost perfect. When Europe healed, Sweden's numbers followed. The negative rate was a sideshow. Meanwhile, the system itself was mutating. Banks struggled, their margins squeezed by rates below zero. Pension funds groaned, forced to chase riskier assets to find returns. Ordinary savers were punished for prudence. The financial DNA of the country was being rewritten. And so, the great paradox emerged. In the pursuit of stability, Sweden created instability. In the name of protecting households, it indebted them further. In the quest for prosperity, it quietly eroded the value of its own currency. The climax of this story is not a single crash. It is the slow realization that an entire nation became the subject of an experiment that worked only on paper while sowing danger beneath the surface. But here lies the real mystery. If inflation's rise was imported from Europe, not conjured by the Riksbank, then what exactly did negative rates achieve? The answer reveals a hidden mechanism, and it changes how we must see the true power of central banks. Here is the secret the headlines never revealed. Negative rates were never truly about inflation. They were about debt. Look at the sequence. In February 2015, the repo rate fell below zero. Within months, the Riksbank launched bond purchases worth nearly 300 billion kronor, 6% of GDP. This was not coincidence. It was design. By forcing interest into negative territory, the central bank made money itself a liability. The goal was to push banks, corporations, and households into borrowing, spending, and speculating. The deeper logic is ancient. For centuries, rulers have debased currency to ease the weight of debts. Roman emperors clipped silver coins. Medieval kings mixed copper with gold. The modern central banker uses negative interest. Different tools, same purpose. Transfer wealth quietly, from savers to debtors, from households to the system. Sweden was not alone. Denmark, Switzerland, the Eurozone, and Japan all entered the negative rate world. Each time, the promise was the same: revive, inflation, fuel growth. And each time, the results were eerily similar. Currencies weakened, housing markets inflated, household debt rose, the surface looked calm. Beneath, pressure built. The hidden mechanism works like this. When interest falls below zero, capital seeks escape. Investors chase riskier assets, property, equities, foreign bonds. Prices inflate. Wealth inequality widens. And central banks, instead of controlling the cycle, become its accelerators. Sweden's story proves the point. In 2018, inflation touched 2%. But this was not triumph. By January 2020, it had already slipped back to 1.2%. The supposed victory evaporated. Yet the debt remained. The inflated property values remained. The weakened krona remained. The real mechanism of negative rates was not to fix inflation. It was to lock the economy into a trap: easy money, fragile balance sheets, and dependency on the central bank's experiment. And here is the chilling part. What happened in Sweden was not an isolated event. It was a blueprint, a test run, a warning. For in every era, when money loses its anchor, the cycle repeats. Rome, Weimar, Germany, the 1,970 seconds inflation spiral. Each time, the mechanism appears different, but the core is the same: debt expanded, wealth distorted, ordinary people carrying the cost. Sweden's negative rates were simply the 21st century version of an old pattern. And the question that lingers is this: if the oldest central bank in the world can gamble with the foundation of money itself, what will the others dare to do next? Because this mechanism did not end in 2019. It still haunts the global economy today. By December 2019, the experiment ended. The Riksbank raised its repo rate back to 0%. Officials spoke as if the danger had passed, as if the test was over. But experiments leave scars. Look at the balance sheet of the Swedish household: debt near 180% of disposable income, housing prices inflated beyond the reach of an entire generation. A currency that had lost 1/5 of its value against the euro. These are not temporary distortions. They are permanent shifts in the structure of the economy. The central bankers promised stability. What they created was fragility. The lesson is stark. Negative rates did not cure low inflation. They did not strengthen resilience. Instead, they amplified the very imbalances that threaten future crises. Sweden's own economists, Lars Jonung and Fredrik Andersson, wrote it plainly in 2020. The costs of negative interest rates to society most likely exceeded the wider benefits. And yet, the temptation remains. Because the machine of modern finance depends on growth, on credit, on the endless expansion of debt. Central banks know this. They dare not admit it. But their actions betray them. When the system falters, the lever they reach for is always the same: cheaper money, more debt, another experiment. The Swedish case is not a footnote. It is a prophecy, a glimpse of what happens when monetary power collides with the limits of reality. Today, the same pressures haunt the globe. The European Central Bank, the Bank of Japan, even the Federal Reserve, all face the same dilemma. Growth slows. Inflation swings wildly. Debt towers higher than ever. And the old question returns: how far will they go to protect the system? For ordinary people, the pattern never changes. Savers lose. Borrowers grow reckless. Inequality deepens. The hidden tax of monetary policy spreads silently through every paycheck, every mortgage, every grocery bill. Sweden was the test. The world is the laboratory. And you, the citizen, are the subject. The Riksbank called it an experiment. But history may call it something else. The moment when money itself was turned against the people it was meant to serve. And the haunting truth is this: once the door to negative money has been opened, it can be opened again, anywhere, anytime, by any central bank desperate enough to keep the illusion alive. So the lesson of Sweden is not just, don't do it again. It is this: when money becomes an experiment, society becomes the collateral.